All right, let's jump right in. We've all seen the shiny promises of financial automation, right? You hear about AI agents, slick Python scripts, instant dashboards. But if you've ever actually tried to build any of it, you've probably hit that wall, that point where everything just breaks. So today, we're going to unpack why so many of these projects fail and reveal the simple, foundational secret to making them work, all based on decades of real-world experience from CPA Sung Lee.
This right here, this is the big idea for our entire discussion. It's a bold statement, and honestly, it might sound a little backward at first. You'd think automation would start with fancy code or some new software, wouldn't you? But the truth is much simpler and way more powerful. It all begins with the structure of your most fundamental financial report, the trial balance.
So here's our game plan. First, we're going to talk about the automation wall and why so many great ideas just fizzle out. Then we'll get into the bedrock of reporting to really understand our foundation. After that, we'll get super practical with designing for automation. Then we'll see how to connect our data all the way to our final reports. And finally, we'll talk about the real prize, getting out of firefighting mode and into generating actual insights.
Okay, let's start with a problem that is probably going to feel very, very familiar to anyone in finance who's tried to get an automation project off the ground.
This slide just nails the frustration, doesn't it? On the left, you've got this incredible promise of what modern tools can do. But on the right, well, that's the reality for a lot of us. Scripts that are constantly breaking, forcing you into this endless loop of manual fixes. You think you're building a superhighway, but you just keep slamming into a brick wall. And here's the kicker. It's not because the tools are bad.
And this is the big aha moment. The problem isn't your Python script or your Power BI model. The problem is the foundation you're trying to build on top of. This is the turning point. Real, sustainable automation starts way before you write a single line of code. It starts with getting your data structure right from the very beginning.
So let's build on that. If the foundation is so important, let's get crystal clear on what it actually is. We're going to define the two most critical outputs of any month-end close. This is the bedrock we keep talking about.
First up, we have the trial balance, or TB. You can think of this as the ultimate summary. Every single transaction, every debit and credit that happens in the company, it all eventually lands right here. It's the balanced, consolidated source of truth for all of your financial statements.
But a summary isn't the whole story, right? You need the details behind it. And that's where the general ledger, or GL, comes in. If the trial balance is the what, the general ledger is the why and the how. It's got all the juicy details, the context, and the audit trail for every single number you see on that TB.
So these two things together, the TB and the GL, they are the bedrock. And if this foundation is messy or inconsistent or just poorly designed, then it doesn't matter how fancy your automation tools are. You'll just be automating chaos, and nobody wants that.
Okay, so we know the foundation is critical. Now for the fun part. How do we actually build it the right way? This next section is all about the practical, hands-on principles for creating a data structure that's built for automation from day one.
This is really where the magic happens. Look at these principles. Just by doing something as simple as creating separate accounts for tax payable versus tax paid, you've suddenly made automating your cash flow statement about 1,000 times easier. The same goes for separating out your asset additions and disposals, or just using clear, human-readable names instead of vague account numbers. And consistency? That's totally non-negotiable. These aren't just little bookkeeping preferences, these are strategic design choices that make automation possible.
And the tool that you use to enforce all of this great structure is your chart of accounts. You got to stop thinking of it as just a list of accounts. It's your strategic blueprint. It dictates exactly how every single piece of financial data gets categorized and organized, which gives you total control over how your final reports come together.
Now, this sequence is absolutely critical. Take a look at when automate shows up. It's step 3. You absolutely cannot jump ahead to automating the mechanics until you have first structured your data and then standardized your process. This is the framework. Get the design right, apply it consistently every single time, and only then do you bring in the tools to do the heavy lifting for you. All right, now let's see how this whole principle works in the real world. This foundational work doesn't just stop with the big financial statements. No, we can take this same logic and apply it all the way down to automating the super detailed notes and disclosures that go along with them.
So the secret weapon here is actually the humble journal entry, specifically that description field. You know, the one that's too often just a random free-form text box? But what if you started treating it like a structured piece of data?
well, then it becomes an unbelievably powerful tool for automation.
I mean, look at this. The solution is so simple, but it's incredibly effective. Instead of your team just typing marketing invoice, you create a consistent, structured format like this one. Now with a structure like this in place, you can use a tool like Power Query or a simple script to automatically parse this information. You can instantly group all the professional fees for the Q4 campaign that belong to the marketing department. This is exactly how you start to automate your note-level reporting.
So, we've laid the foundation, we've connected the details. But why does all this upfront work matter so much? Let's talk about the real payoff, the actual end goal of this whole process.
Because let's be real, this isn't just about saving a few hours at the end of the month. It's about building something much, much more valuable, a sustainable, scalable system that you can actually trust. The whole point is to shift the finance team's role from being data janitors to becoming strategic partners to the business.
And here are the benefits. When your foundation is solid, you gain control over your data. You get real transparency in your reporting because every number can be traced all the way back to its source. And that builds trust in the numbers, not just for you, but for your entire organization. And the end result? You get to spend your valuable time analyzing what the numbers actually mean, instead of constantly firefighting errors and trying to fix broken scripts.
So, this brings us to the one question you should be asking yourself right about now. Take a hard look at your own chart of accounts, at your own trial balance. Is it designed with intention? Is it structured in a way that would make automation simple and elegant? Or would it just automate the chaos you're already dealing with?
Ultimately, this is the single most important thing to take away from our chat today. The most successful, robust, and elegant automation projects, they don't start with complex code. They start with a clean, logical, and well-structured financial foundation. So take the time to design it right, because I promise you, your future self and your future automation will thank you for it.